the market-making liquidity providers pulling their NSFR compliant offers to sell physical bullion into a bid-only condition. Who the hell wants to sell anything in a bid-only condition, exacerbating the problem? And this is where the first-tier liquidity providers' consensus of $25 equilibrium point is calculated. $25 is $2,500 is considered by most first-tier liquidity providers to be an actual fair value for gold in 2024. How much physical gold and silver do you own as we enter a massively bullish 2024?
As we approach the highly anticipated and bullish year of 2024, the outlook for gold generates considerable attention and varied forecasts from market experts. British commodities trader and whistleblower Andrew Maguire has set the benchmark at $2,500 for gold in 2024, emphasizing its monetary nature and engagement in foreign exchange markets. The recent surge in gold prices, rebounding above $2,000, has reinforced its strength, finding immediate support at around $1,980. With prices maintaining positions above the 100-day and 200-day moving averages, the upside momentum appears intact, contributing to the positive sentiment surrounding gold. As 2023 draws to a close, various financial institutions are putting forth their predictions for gold prices in 2024. Bank of America anticipates a push to $2,400 per ounce. Saxo Bank sees gold reaching $2,300, and Wells Fargo is closely watching for $2,100. Amidst these forecasts, Andrew Maguire raises a thought-provoking question about personal ownership of physical gold and silver in the context of a massively bullish 2024. He emphasizes that gold, as a monetary metal benchmarked against fiat currencies, offers a safe haven during times of crisis or uncertainty, protecting investors from the potential pitfalls of rapid inflation or devaluation. Maguire points out that the entry of gold into the first-year asset class has disrupted historical inflection points traditionally relied upon for over 50 years. The unprecedented performance of gold during the COVID-19 pandemic has further highlighted its highly liquid nature, surpassing many other major asset classes in terms of liquidity, as indicated by World Gold Council data. In distinguishing gold and silver from other commodities like oil, Maguire underscores their behavior as monetary metals. Their unique attributes appeal to professionals seeking to safeguard wealth, especially in an environment of economic volatility and shifting market dynamics. Before diving into Andrew Maguire's insightful interview, subscribe to our channel and give this video a big thumbs up.
The buyers holding these physically backed spot index purchases at $2,000, as we saw following the chart painted selling, they don't care if, for example, the price of gold rises to $2,500 or so. It doesn't matter if it's $2,500 an ounce, because, and that they don't care if it rises before they demand delivery, because they have locked in the price at 2,000. No one knows if these spot purchases are just longs being hedged or are going to be demanded for delivery until it is actually demanded on the day. And this is why the growing spot index demand overhang will have the house insiders exposed to this physical delivery conversions. It'll have their attention big time. Now, clearly, there's a lot going on. So to bring a balance to the one-sided technical view at the house, the officials capping gold against US treasuries and the dollar, what they 100% rely on is synthetic chart painting inflection points and to lead the pack to sell highly leveraged, non-Basel III compliant, unbacked synthetic COMEX gold. Now, accepted at face value and blinkered to the growing physical to paper market disconnect, the pack will dutifully chase the technical patterns until they break, fulfilling the chart painter's objective, oblivious to the fact that gold is a monetary metal competing in the foreign exchange markets and benchmarking new record purchases against every single fiat currency. Worse, they're oblivious that the drain of physical market gold underpinning their leveraged casino bets is concurrently draining the liquidity that the officials actually rely on to cap the dollar price of gold. Now, meaning that while the blinkered specs borrow gold from the insiders to sell, the house must go long to protect these EFP outflows. This limits the downside, and it is why during 2023 we have secured a succession of higher priced gold market stairsteps, just what we're seeing now. And as we enter the end of 2023 trading, I can't believe it, in just over 2 weeks, this physical effect will continue to catch up on the only central bank still capping gold, the Fed. And they know it. However, not so the pure technical traders blinkered to this unseen and deliberately unreported power of the unleveraged physical markets, which because gold became a first-year asset class, is actively eroding this 50 years of relied upon historical inflection points, the anchors for these inflection points. And much like we evidenced in November 2022, when everyone was actually bearish, extrapolating these unhinged synthetic actors is going to once again wrong foot these top callers. Unlike every other central asset class, gold and silver are monetary metals and do act differently to commodities such as oil, where one never takes physical delivery. And therein lays the difference in how these speculators, CTA speculators, operate in gold. Namely, gold is able to be backdoored, EFP'd, out of the COMEX for physical delivery.
Andrew highlights that global central banks, excluding the Federal Reserve, are actively involved in both open and covert efforts to purchase physical gold to fortify their respective currencies. According to estimates from the World Gold Council, central bank demand contributed significantly to gold's performance in 2023, adding 10% or more to its overall gains. The WGC anticipates that even if 2024 doesn't match the same heights, continuing above-trend buying by central banks should positively impact gold prices. Financial expert Peter Schiff discusses the Plunge Protection Team, a government-operated team that buys stocks during market declines. Schiff suggests a parallel surge prevention team for gold, speculating that the government might sell gold futures to suppress prices during significant spikes, similar to strategies used in stock markets. Andrew echoes this view, underscoring the PPT's critical role in preventing a bid-only market scenario during a gold breakout. Without PPT intervention, gold could have surged even higher, reaching around $2,500, illustrating the impact of these interventions on gold prices and the broader financial landscape. Let's get back to the interview.
Every single global central bank except the Fed is on and off record buying physical gold to really bolster their respective currencies. A higher gold price support level from which a revaluation could be justified would not be unwelcome. And the Fed's need to cap gold against the dollar is their Achilles heel. And every other central bank absolutely knows it. So whatever the trigger was to spike gold higher, it's absolutely clear that if the PPT, which is the only admitted existence, PPT is obviously, and to those that don't know, it's an openly admitted. It came into existence pretty much, although they've been in different forms after the 2008 debacle. There is a Plunge Protection Team, and had this team not stepped in to rescue the gold market breakout from triggering the first of a series of CME market, and CME is the exchange that the COMEX is a part of, one of the exchanges that the CME run. If these CME market halt circuit breakers, they were configured at $2,150. If it hadn't been triggered, they would have lost control through a series of market halts into a bid-only market. At best estimate, gold would have pivoted higher to around $2,500 over the Monday session. And we'll look at that in a minute. Now, whatever it was that triggered the gold price to spike higher in these thin conditions, we don't think it was the insiders risking losing control of the 10 times larger foreign exchange gold physically backed delivery market just to paint a top. So yes, they did paint a top, but they didn't plan it. And while they need every single tool they actually used every single tool in the toolbox to cap the rise with massive quantities of paper gold. The very obvious official gold market intervention did reveal a very weak hand. Namely, the only tool left for officials to intervene in gold is 100% reliant on how many siloed casino speculators can be led by the nose to take the bait. And of course, by design, that's exactly what these programmed algos did. Like a dog chasing a bone, these momentum chasers reacted to the deliberately chart-painted technical sell signal, and then they began to bet against gold. Now, the reason we're highlighting this is because this growing chasm between the paper and the physical markets that we've been tracking all of 2023 has presented a huge opportunity, another opportunity window. What the insiders are doing, who are exposed to the physical markets, accumulating cheap gold and related silver into this group of speculators. Now, we've identified this group of momentum-driven speculators. They are the commodity trading advisors who are relied upon to never take delivery of borrowed COMEX gold. And whether they buy it long or short, it doesn't matter. But through massive amounts of leverage, they actively trade close to a staggering 85% of all the casino chips loaned to them by the house pit managers.
Are we considering the disruptive impact of gold entering the first-year asset class and its exceptional liquidity during the COVID-19 pandemic? How will these factors shape the investment landscape in the coming year? How will gold respond to the various forecasts presented by market experts, including Andrew Maguire's benchmark of $2,500 for 2024? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.